What's up, you guys? All right, so in this video, I'm going to be going over my second edition of my Investing 101 series. And in this video, I'm going to be breaking down what is the smartest and most efficient way to retire a millionaire or a multimillionaire for people that want to have as little to do with their finances as possible. Now, in this series, I'm going over pretty much everything that I've acquired over the past 5 years in knowledge based through experience or books that I've read, and I'm going to be breaking that down for the everyday person, just to kind of open the door to their financial journey and allow them to understand what the financial world is and why it's not that scary and where they can go to learn more. Because again, I'm not a financial advisor, and I'm going to be showing you the books of where all this information is coming from. So this video is just for me to express my opinion and kind of relay the information of those books. So if you want to dive deeper after this video, make sure to read those books, even just read the reviews, whatever. But I'm trying to go as thorough as possible during this review. So I hope you guys get some benefit out of it. Now, if you guys are new to my channel, my name is Dan and this is Millennial Investing. This channel, I'm going to be talking about finances and tech related topics. So if you're interested in either one of those topics, make sure to stick around, hit the subscribe button, and let's jump right into the video. Now, I'm assuming you all know from the title of the video where exactly I was going with this. And so what I have found reading these books, that dollar cost averaging into index funds and slowly automating your investments over the long term with all your extra income is definitely the easiest way to ensure that you retire a multimillionaire and that you have to put in as little work as possible. Now, all this information has come out of these 3 books, and I want you to know that none of these thoughts are my own. This is just coming raw out of these books, and I'll go over them what they are right now. And so that way you guys can look into these books. I'll link them down in the description below. You can look into these books and really understand exactly what the author meant, who the people that are interviewed in the books we're talking about, and then what their track record is, and then exactly what else they want for you to do. So this is just going to be a breakdown of these 3 books. Now, the first one is going to be The Little Book of Common Sense Investing by Jack Bogle. This book mainly talks about ETFs and why ETFs statistically perform significantly better than individual investors and fund managers, especially when you take into account the amount of fees that fund managers give you. The Intelligent Investor, which is written by Benjamin Graham, who is Warren Buffett's teacher and idol. And this book has now been revised by Warren Buffett. And this book kind of breaks down what the difference between a defensive and an enterprising investor, and who should really be a person that decides to invest in individual stocks, or who should just, take the easy approach and invest in the index over the long run and expect better returns than the average person picking stocks individually. And then Unshakable by Tony Robbins is kind of a motivational book that focuses around why you really need to keep your head strong, especially when the market takes a downturn, and not allowing fear or greed to really get the better of you. And so that way, the slow and steady approach, especially through index funds, is definitely the most guaranteed out of any type of investment, because they all have some risk, is going to give you the highest rate of return on your money over the long run. So I'm going to kind of break through what these 3 books are going to individually now, and kind of giving my overall summary of what a strategy using all 3 of these books is. And hopefully you guys get some use out of that, and hopefully you guys can even, start to apply it to your own lives, and then maybe to look even further into, talking to your financial advisor and figuring out which of these methods do you really want to go with. And so for the first book that I want to break down is The Little Book of Common Sense Investing. Now, in this book, Jack Bogle, who is the founder of all the Vanguard ETFs, and he's the one who kind of made it available for any retail investor to invest in the index funds at a very low cost without a lot of money, and that way they can just ensure that they will get the market's return without having to buy what used to be a multi-$1,000 index. And he made that all available, and then this is the book that he wrote as to why he thinks that is so important and to what he recommends for individual investors. Now, the main point in this book pretty much boils down to the S&P 500 over the past 40 years. Depending on it changes depending on what date range you're looking at. But on average, for the past 40 years, you can expect, assuming you have a 40-year time horizon from right now, based off of previous patterns, you can assume a 7 to 9% compounded annual rate over the long run. And so this is what's considered the market average, and it considers if you can beat it, you're considered a good investor. If you meet it, you're considered average, and if you're below it, unfortunately, like the average investor, you underperformed the market, and generally you did a lot of extra risky plays and you did a lot of extra homework that gave you no real fruit to your labor. And kind of furthering on that note, the retail investor during the same time frame averages between 2 and 5% a year. And now, I'm not saying that individual investors cannot outperform the market. Obviously, through Peter Lynch, Warren Buffett, Charlie Munger, you can pull up as many names as you want, and there are people that have beaten the market over the long run. However, this is going for the average person that's going out there investing. These are people, the ones that have beaten it, are generally people that like to devote all of their time to investing and beating the market. Now, you're definitely able to do it, assuming you want to buckle down and do all the work, and you have that type of discipline. But for the average person, and for I imagine most of you watching this, it is not that smart to try to beat out the market over the long run. Now, there are some issues with ETFs that are kind of not directly talked about in this book, but the issue with ETFs is that it's very liquid, and that people look at ETFs like stocks rather than index funds because they can buy and sell them quickly. And so anytime the market has a reaction, like say if the market tanks, people immediately sell it rather than buy more. And that's actually the main reason why retail investors do so poorly compared to index investing. Because the index, if you're betting on pretty much the American economy or whatever economy you have an index in, all that you have to bet on is that it's going to still be there and still going to make money in the future. When you're a retail investor and you start to let your emotions take control of you, you now assume that you can time the market, you know what's going to happen next compared to everybody else that is also trying to figure it out. And it gets a bit overwhelming, and that's why the majority of people do not outperform the market. And so you really have to, be a very unique group of people if, in my opinion, and in Jack Bogle's opinion, if you want to try to say that you can beat this continuously over the long term and actually get that return that you expect, like say like a 10 to 12% return compounded over the next 40 years, which is great. And it is very doable, but just really have that heart-to-heart with yourself. Like, are you willing to, one, dedicate yourself to that? Are you willing to take that extra risk? And are you that well disciplined to be able to, follow through and not let your emotions, sway you, unlike the market? So the next book is The Intelligent Investor. Now, this book, written by Ben Graham, is pretty much the Bible for value investors. And while, saying that there's one point that stands above the rest is doing, somewhat of a dishonor to the rest of the book, and because every chapter in this book is gold, the main concept that is stressed here is the concept of dollar cost averaging. And with dollar cost averaging, you take a fixed amount of your income that you don't need, so the amount of money that you can invest, and you're going to break that up in a monthly interval. And so say you can invest in total $12,000 throughout the year. After everything, you have $12,000 extra. You should break it down to that every month on a certain day, you spend $1,000 in investing. You do not lump sum invest, which is, I have $12,000 right now, I'm going to put it all in the market right now. You want to average into it. And let me show you the main reason why. So you can look at just about any market, and you're going to notice somewhat of a pattern. Pretty much every market, including the S&P, follows this type of a pattern, where it's going to be going up, it's going to be going down, and you generally refer to these as peaks, troughs, which is the bottom, recovery, and recession. So what pretty much happens here is you have a booming economy, and the economy is doing really well, everything's growing, and people are getting more jobs, people are getting paid higher, everybody's buying new tech gadgets, everything's doing really well. That's generally when you're in, this recovery-esque growing bull market, which is kind of what we're in right now. And then eventually you hit this point, and that is the peak of the market. Now, no one can time this, and because again, if you could time it even twice, you would be like one of the richest people in the world. So don't attempt to try to time a market, because no investor, nobody that has a lot of money has continuously timed the market over and over again. There have been very beneficial speculative plays with risk management, but do not try to time the market. No investor recommends the average person to attempt to time the market because it's almost guaranteed that you'll get it wrong. Sorry to really harp on that, but I cannot stress that enough. Do not try to time a market. Anyways, so for some reason, you eventually hit a peak and then you start to come down. So for example, back in 2007, it was the housing fiasco. Everybody was inflating subprime mortgages. It was making the values of houses skyrocket. Everybody could buy anything they wanted with debt. And then eventually people realized, oh wait, these things aren't worth what I'm paying for, and no one can actually pay up their credit once the rates changed. And then you had a really bad recession. People lost jobs, economies collapsed, businesses went bankrupt, people lost their job, people lost their house, people lost their car, some people died, and it's never a good time. But eventually, during the downturn, every market so far, or every developed market so far, has hit a trough. And the trough is when you hit rock bottom, pretty much. And then once you hit rock bottom, you eventually start your slow recovery and your slow incline back up. And you continue to go up here, and then look at that. Eventually, you're going to hit another peak because nothing can keep going up forever. And the pattern, so on and so on, continues. Now, this is a very, very brief and rough sketch of what an economic cycle looks like, but that is what is shown time and time again, and you can look at any index for it. Like that you don't even need to really do much. You can just look up the S&P 500 on Google, and you will see this pattern. And the point of dollar cost averaging is to negate this volatility, because you're thinking for the long term. You want to retire knowing you have a lot amount of money. You don't want to retire here, put on all your money, and then realize, okay, I have to pull out my money now because I'm no longer working, and my investments are worth 50% of what they were 3 years ago. No one wants to be in that situation, so you have to ease into things. And so with dollar cost averaging, you have this type of a reaction. And the main reason why you pull this off and it doesn't just kind of net with the market is because you have to realize proportions and percentage change. So if we want to look at one cycle, if you start with $100 here, at the very tip of the market, if you put in $100 and we have a recession that goes down 50%, and now you only have $50 in the market, that's pretty bad. You just lost half your money. But then, assuming the market recovers, doesn't even have to beat, just recovers to where it was right here, rather than going up 50%, you have now gone up 100%. So what would you rather do? Would you rather be here, watch half of your money go away, and then go through all this and just make it back at net zero? Or would you rather have, say, put $50 in here, $50 in here, and then walked away with over $125 here? I don't know about you, but I'd rather go for this approach. And that's kind of the nature of dollar cost averaging. You need to sort out through all the noise and through all the good and bad things about an economy and just really capitalize when things go wrong, because you're betting on things going right. And the thing to kind of, ease the back of your mind with that is that, say if everything's tanking and you're afraid to invest, and this is going to be the hardest point in time to invest, and this is really the only big challenge that comes with dollar cost averaging into an index, assuming you always have money to invest, is that it is going to be terrifying to invest in here. The average person did not want to be throwing their money, during 2008. They didn't want to be throwing their money into a collapsing economy that everybody thought was failing. Banks were failing. There were bailouts. There were people that were going to jail. Everything that you could possibly think of that was going wrong at this particular moment. But people like, say, Warren Buffett threw money at the market at this point in time. And then they catapulted themselves to being even richer than they were. And that is kind of the schema as to why the rich get richer, is because the rich have dealt with this. They know what to do. They have their money readily available. They throw it when things are cheap, and they sell it when things are expensive. So really getting that into your brain is going to be difficult. I know everything seems easy, in either hindsight or everything looks 20/20, but this is going to be the key to how you fare overall when you go to retirement. And so what the book recommends, what The Intelligent Investor, what Unshakable, and what Common Sense Investing all recommend is that you continuously buy down here, because all that you need to do is you need to bet on America will continue to be America, and it will continue to be a great place for businesses. Now, regardless of the political climate, if there's one thing America can do, it's make money. We cannot, whether you're pro-healthcare, any type of buzzword or big hot topic in America right now with social issues, that's all on the table, and that's all just depending on how you're brought up and what you're looking at. But the one thing that no one can say wrong is that America makes a lot of money, and that businesses love being in America because Americans love to buy things. And that is what drives our economy up, and that is what has recovered us from even the horrible times of the Great Depression and the Great Recession. And you can kind of rest assured that Americans will want to continue to buy things in the future. And so as long as they want to buy things, as long as companies want to make things, you will always come back from the market, or at least you always have in the past. Nothing's guaranteed, but in a couple hundred years of the stock market, especially within America or the developed nations, never has there been a peak where they haven't recovered from. So that's kind of the gist as to what you really need to do to ensure you can dollar cost average effectively and why dollar cost averaging is so important. Now let's jump right into the next book. So I've already gone over a lot of the topics that are discussed in Unshakable by Tony Robbins, but the biggest thing to think about that is brought up in this book that isn't covered in the other two is how much more expensive it is for you to invest in a mutual fund than it is to invest in, say, a Vanguard ETF. Now, ETFs are very passive, they're not actively managed, so all they have to do is they just have to keep their money in whatever the index is. So they have very little work to do, say, once the ETF is made. Mutual fund, though, is someone that is constantly timing the market and they're attempting to beat out the average returns, and you're paying someone pretty much to manage your money. Now, again, going back to the whole 86% of these do not beat out the market on average, paying 3 to 5% for, on average, subpar returns over a 40-year period of time seems like a pretty unfair deal. But it's a little bit, it's a step further than that, even what you think. On average, if you say we're losing, 3 to 5% on top of whatever you would be spending, assuming they were the exact same returns, assuming this performed 9% per average and this performed 9% per average. What's discussed in this book is that because of the power of compounding, and I can do a separate video on that if you guys want, but it's a pretty simple terminology that you can look up and kind of look at a compounding calculator to see how impactful compounding is. If you're, say, going at the same rate, but you're losing this amount each year compared to the 0.4% or whatever it is, you can say goodbye to roughly 66% of your overall returns. And so what that kind of boils down to is, so say if you retiring with $1 million was your goal, if you went with the mutual fund route and it didn't severely outperform the market to the point where this fee was, negligible, say if it's beating out the market, 6% a year, yeah, that's fine. Pay that fee because you're going to beat out the market. But most of them don't, so think about that and make sure you look at their track record if you choose to go that route. But so say if you have that $1 million goal and say you hit it with the market. Say if someone were to hit it with the market. This person is only looking at $333,000 compared to $1 million. I don't know about you. I'd rather take the $1 million, especially because there's no effort involved. Dollar cost averaging, you set it up, you can automate it with most apps. You can go say on M1 Finance, or you can set up a broker and automate certain percentages of your checks to go straight into it. And you don't have to think about anything, and you're going to be doing 3 times better pretty much than someone that chose a mutual fund, took all the time to look for a mutual fund and pick it. And to me, it's just not worth it. Now, there are mutual funds that do beat out the market over the long term. They're pretty hard to find because generally, whenever they're found, more and more people dump money into it, and due to the laws of diminishing returns, the more money that the fund manager is using, the harder it is to get good returns. Hence why you look at, say, Warren Buffett averaged 30 to 50% a year, and then the second he started managing, billions and billions of dollars, now at almost $500 billion, he's, just kind of keeping pace with the market and slightly beating it. That is still a great feat, by the way, but it's just not the same. So it's really difficult to find, a young fund early that is going to beat out the market over the next, say, 10, 20, 30 years before everybody else does, and it only affects those returns. So at the end of the day, for the average person, assuming you can, keep a hold of your psyche, and assuming, you don't go in and out of anything quickly, and you view, investing in an index as I'm invested in this until I go to retire. I'm not taking out this money for any reason, second hand of an emergency. I'm not taking it out for anything other than when I go to retire and I want my income. ETFs from these 3 books are pretty much, or index funds, are definitely the best way to ensure that you retire multimillionaire. And now if you've stuck to the end of the video, and I assume you kind of like this, or you at least want to start looking to where to go, some of you might be thinking, oh, this is great, but I'm going to need to get a great paying job so I have enough money to invest, so that way, I have all this stuff. And I want you to kind of know that that's not exactly the case. This type of investing and this type of retirement is extremely attainable for everybody. I'm not saying it's not difficult, but it's attainable. So assuming, using like say Massachusetts, just because I know them the best, assuming you make between $11 and like say $12 an hour, so that's about minimum wage. If you work 40 hours a week and you can save 20% of your income, and again, I'm not saying that it's just easy for everybody to save 20% of their income. I'm saying just if you can do it, if you can scrounge up, if you can, do some side hustles, pick up like an Uber route, something. If you can get 20% of your average income, and that equates to about $5,000 a year, which again isn't a lot, but it's something. If you can get $5,000 a year that you can put into an investment, like say the market, you dollar cost average it, and you walk away with 9% compounded returns, over 40 years that returns about $1.1 to $1.3 million. And so that's why you really need to think about that compounding is your friend, and that if you don't retire a millionaire, a little bit of shame on you. I know times are tough, and I know things are really hard, especially for young people. Like I'm straddled with that. A lot of people straddled with that, and that's a whole nother issue that I'll get to later. If you are willing and able to invest, I highly recommend you do that. Whether you're paying a financial advisor, whether you want to learn it like I have through books, or whether you want to watch a bunch of YouTube videos and then do your own online research, please just invest. I have seen so many people struggle with money, especially when they go to retire and they're afraid to retire because they can't afford their medication or their health bills, or they don't know if they can afford to keep all their utilities on, or their rent or their house or their mortgage or anything. And that makes me very upset. And it makes me upset because it's very simple, but no one's taught it. And so I hope that if you've stuck around to the end of this video, you at least, it hits home, and you at least take the time to educate yourself that, because I truly do not believe that anybody who lives, in America, or that anybody has any sort of disposable income at the end of the day after all their expenses, I don't think you should ever retire sub, $1 million. Worst comes to worst. Okay, yeah, we hit a recession right as you're about to take out the money and it drops down to $500,000. Oh well. I think the average person should be able to hit $1 million easy for retirement. I really do. And there's, numbers, math, and statistics to back that up. I just think that the reason why it doesn't happen is because, everybody says, oh, people are bad with money, people are bad with that. I honestly think, yes, people all do like their vices, but people just aren't educated. And so hopefully I got through to at least one person with this video, and, 40 years from now, they don't have to worry about money. That's my goal. If one person doesn't worry about money in 40 years, I'm okay with it. Anything that I throw out on this YouTube channel, it's completely worth it, as long as one person can retire a millionaire. So, yeah, sorry to get a little heavy there, but, just really passionate about it. Anyways, so thank you guys. If you stuck around, please like and subscribe. Makes me know that, you like this content and whatnot. And I'll try to continue to put out as much of this content as possible, and I'll try to upgrade this series, to kind of cover everything that I've known. I'll probably talk about college debt and college issues also, because, that affects me and affects my friends. So I'm going to try to give some advice that I can do in that regard. And yeah, so I hope you guys liked the video, and I'll see you in the next one. Peace.